both started on the trading desk in a very different era.
Whether it was levered loans, high yield bonds, the expectation was that they were never going to trade. First, you saw the evolution of the high yield bond market, and that was DTC eligible, and those settled quickly, and so you start to see the trading of the high yield bond market. Levered loans sat on banks' balance sheets, and one day, in the early 90s, Jimmy Lee said, why shouldn't levered loans trade? And really that question is what prompted the trading of levered loans.
And it's incredible how when a product starts to trade, what goes from a very small marketplace with just a handful of players, as transparency and education start to compound, it's the growth of an asset class.
Yeah, I think that's what we're looking at in private credit.
There's a lot of headline myths out there about private credit, especially private credit in the IG world. What do you think a few of those myths are, and how have we confronted the reality?
Yeah, I think when people talk about private credit, I think a lot of our competitors are talking about this small pond of direct lending. That's a market that's about $1.8 trillion. We're really talking generally around the investment grade private credit market, which is an addressable market of about $40 trillion. And so we're really focused on that much bigger pool. We deliver a couple of things. We can deliver speed, certainty, and scale. And so issuers are willing to pay a little bit more for any of those bespoke features.
As you point out, both in the small pond of non-investment grade direct lending and in the large $40 trillion marketplace of investment grade private credit, in both instances, what we're providing is the company with a financing opportunity that the public markets did not offer them. And whether it's with a large company like Intel or AB InBev, there was a bespoke nature to our financing that, while the investment grade public market would not have embraced that. We think it's going to be a common occurrence for companies, investment grade and non-investment grade, to have public and private tranches that certainly allow the company the flexibility and the financing needs. Where do you think, when you take a look back at in the high yield marketplace that we saw in the 80s and 90s, and the adoption of high yield bonds and broadly syndicated loans, that was a multi-decade evolution. Where are we now?
I'd say we're somewhere between the second and third inning of investment grade private credit. We talk a lot about the global industrial renaissance, energy transition, data centers. These are all investment grade companies that need to spend huge dollars in CapEx. And so they're going to need bespoke solutions. Those solutions are going to be found in the private credit markets.
Well, to your point, a lot of the growth in the 80s and 90s were in industries that were coming of age. The contrast now is the capital needs are even longer duration, 10, 20, 30 years, data centers, transmission lines, and those are typically areas of investment grade companies. Just address a little bit about our relationship with the big financial institutions, the big banks. A lot of headlines are put forth about how it's a big battle, and how would you summarize the overall relationship, friend or foe?
The banks have welcomed us with open arms. I think they realize the direction of travel is that private credit's going to become more liquid. And they can either be at the front of the wave or they can be under the wave. And I think they've really embraced the fact that they want to be our partners in this. They have tremendous front ends. They are great at generating assets. They have great corporate and sponsor relationships. We're never going to build out a significant front end like the banks do, but we want the assets. And it feels like it's a marriage made in heaven. They get to keep their client, and we get to source an asset that we want to own.
What's taken place in the Apollo alternative asset trading platform?
It was born out of providing good service for our LPs. And what comes with the addition of transparency and liquidity is you broaden the aperture for the number of investors. We realized that while we were providing the service to our LPs of adding liquidity, we were also solving the issue of public-private conversions. We've onboarded a few hundred counterparties. We've added a number of banks into the ecosystem. This feels very much to me like the broadly syndicated market in the mid to late 90s.
Yeah. One myth out there is that you only get the incremental yield because of the illiquidity that you perceive that you're giving up. We have really found that the liquidity discount is not great, but also the premium that one receives for being an issuer, it's really on the origination side.
Origination is where alpha is created. You're solving a problem for an issuer. They need either speed, size, or certainty of execution. And I think that that's where we can really add value.
I think what we have found time and time again, it's the one who can originate and scale that's going to harvest that premium.
I don't see a scenario where there isn't a broad buyer base of all these private assets. I think you will actually see private credit trade more actively than leveraged loans. I think you will see private credit in the widest variety of investor hands. And I think you end up seeing private credit trading and clearing on chain at some point in the not so distant future.